Welcome, everybody. My name is Rege. I'm going to be taking over Floyd's Anchorage Meetup for the summer. This is the first one of the summer session, June 13th, 2024. My email address is on screen, omg.investors@gmail.com. If you guys need to reach out to me with any questions, comments, or concerns after the presentation, feel free to do so. A recording of this entire meetup will be available. Floyd will send that out to everybody a few days after this meeting. All of these slides will also be available in PDF format at the same time. Floyd will send that link out to everybody through the meetup section. At the bottom left of every slide will be a slide number. The bottom right, this is slide number 1. If, as I'm going through the slides, you have a question and I happen to skip the slide or move forward, just write down the name of the slide that you have a question on. I'll hop back into it and we'll go through. Okay. So let's get started here real quick. All right. So the first thing we got to cover is a disclaimer. All comments made and materials presented during this Anchorage IBD meetup are for educational purposes only. They're not intended to be interpreted as investment, buy, hold, or sell recommendations. All investments have risks, and past performance is no indication of future performance. And the possibility of losing money is a risk each investor will be willing to accept. The personal responsibility of each individual investor is a key point. If you accept the provisions in the disclaimer, you can continue to participate in the meetup tonight. I want to thank Floyd Dameron for putting this whole LETF investing methodology together and working on it so diligently for years. I want to thank Rick Kelleher to take that manual methodology, putting it into Excel, automating it, and then Gary Taylor for putting together this whole thing into TradingView to make it even faster and quicker. And lastly, Miss Amy Smith from IBD will allow me to present on Floyd's behalf. So what is the agenda for today? We'll quickly take a look at the IBD market pulse. We'll take a look at the leverage ETF performance year to date. And then we're going to go into a lot of detail over the weekly stochastic strategies, comparing the primary versus the alternate strategies. What we're looking at here is a detailed comparison analysis of year-over-year results, annual drawdowns, win rates. And then what we're going to do is we're going to see if we can take weekly stochastics and if adding a fixed profit target can improve results. We'll also tabulate those, break them down year over year, and finding an optimal profit target across different time frames. Once we covered the weekly detail, we'll move to daily stochastics, and we'll see how a daily stochastic strategy performs, again, with detailed analysis and comparisons. Lastly, we'll talk a little bit about drawdowns and losses, and then we'll have a Q&A. As I said before, at any point in this presentation, if you have a question about a slide, there's a slide number on the bottom right, just raise your hand or unmute and talk, and I'll be happy to address that. We're going to go through a lot of numbers, a lot of details. Don't freak out. We'll be going through it step by step so everybody understands everything. Are there any questions at this point? If you have questions, simply unmute yourself and ask, or there's a little hand raise button in the middle of your screen, which you can click on, and we'll work through that too. This is the market pulse as of the morning of July 13th. Small caps lead, broad market advance, an exposure of 80 to 100%, one distribution day on NASDAQ and 3 in the S&P. And these are the leaders up in volume and the leaders down in volume. Today, as of this morning, from the June 13th a.m. This is the leverage ETF performance year to date from Google Finance. You can see so far year to date, the TQQQ is up 49.5%. SLXL is up 109%. FNGU is up 88%. And the TECL is up 56% year to date. These are all from before the market opened this morning on June 13th. All right. For those of you who've been with us for the past several meetups, you know that both Rick Kelleher and Floyd Dameron we're working on weekly strategies. They could then input into the Excel program Rick had created to see what result they would get. Through their backtesting, they came up with 2 separate strategies that work for them. So we have the inputs. We have in both cases, they're MS weekly, which is Market Smith Stochastics weekly. If you take a look at some of the previous meetups, you already know what Market Smith Stochastics are like. They're calculated a little differently from full stochastics. Floyd has been kind enough to share the Thinkorswim script for that. If some of you still don't know what that is, please refer to Floyd through Meetup, and he'll be happy to share those stochastics with you that you can use in Thinkorswim or any other program you're using. In Floyd's case, he uses a 533 stochastic, as does Rick. For the primary strategy is 13%. Rick sets at 5.8%. Floyd's, they both have a trailing stop about 18%. Long is between 10 and 100. And the exit cross is at 37 for the primary strategy, Floyd, and 45 for Rick's alt strategy. So just like look at the returns from January 1, 2013 to December 31st, 2023, at the 11-year period, the primary strategy turned $10,000 into over $600,000 on PQQQ. In that same period, the alternate strategy turned $10,000 into over $400,000. If you had just stuck with a buy and hold strategy from January 1, 2013 to December 31st, 2023, you would have turned your $10,000 into $450,000. Now, those numbers are very impressive, but what we want to do is to delve deeper into those strategies to see what happens every year and what an investor really has to deal with year after year and what they can handle. Anybody have any questions so far about these inputs? For those of you who have been using the TradingView script or who attended the previous webinar in May, Gary Taylor went through a lot of detail explaining how the TradingView script works and how easy it is to use. Here I've taken a screen grab, and on the left are the inputs that we use for the primary strategy, which we showed above in the previous slide. And on the right, we have the inputs for the alternate strategy. You see on the top right, we choose W for weekly, MS for market Smith stochastics. We set a trailing stop, which in the alternate is 18.8%. We set a daily stop, 5.8%. We have a 45, which is the overbought number, and stochastic settings is 533. And if you look on this side here, you'll notice these are the entries for the primary strategy. The oversold number is 37 for the primary strategy. So these are the inputs we put into TradingView. We set the dates to go from January 1, 2013 to December 31st, 2023, and it produces results. In the subsequent slides, you're going to see a column called Account Value End of Year. And that's going to display the actual dollar amount in the trading account on December 31st. Basically, it's important for you to understand this. If there are no open trades in the last trading day of the year, we simply calculate the value of the most recent completed trade. And if there is an open trade on the last day of the year, we simply multiply the number of shares by the closing price of TQQ. For example, if on December 31st, your account has an open trade with 100 PQQ shares and the closing price is $10, the value of your account will be $1,000 at the end of the year. Pretty straightforward. This table is something I have created. It requires manual work. The TradingView script does not create this. It takes a lot of time to put this together, but I wanted to show it to you. Don't worry about all the details right now. We will go through them in depth so you can get an understanding. When you go back and look at the presentation later, you'll understand what all of this is. It'll be much easier to figure out. Again, there's 3 sections here. If you look at, there's 2 vertical gray bars. On the far left of the first gray bar, you'll see 3 columns. That is the account value and your P&L if you have simply bought and hold. On the top left, January 1, 2013, you start with 10 grand. All 3 accounts start with $10,000. The first 3 columns on the left are what happens to buy and hold. The middle columns between the gray bars are an application of Floyd's primary strategy with Floyd's inputs. And to the right of the right gray bar, these ones right here, which says the weekly Rick alt strategy. This is showing you what's happening year over year, and we'll go into more details soon. Does anybody have any questions at this point? Please unmute yourself and ask, or press the hand button on your screen at the bottom. Okay. So let's just take a look at one line the first year in 2013. If you had started with $10,000, at the end of December 31st, 2013, if you had just bought and held, your account would have had $23,973. You would have had a buy and hold return of 139%, which is really good. If you look at Floyd's primary strategy inputs, you would have an account value of $18,531, P&L for that year of 85%, a drawdown of only 8%. Floyd's strategy would have had 5 round trip trades. Anytime you see a round trip trade, that's actually 2 trades. So you have to multiply that number by 2. In Floyd's case, that would be 10 total trades in the whole year, and 80% of those trades were profitable. If you look at Rick's strategy, the alternate inputs resulted in an account value of $15,894, so about 59%, a max drawdown of 16%, and a total of 10 round trip trades, which is 20 total trades in that year. This is essentially how to read the table from left to right, so that when you guys go back to the previous table with lots of data, you'll know how to read it. Anybody have any questions on this so far? Remember, this is something that I had to put together manually. It takes time, but it's worth it. So anybody can analyze it in more detail before they pick a strategy that they want to move forward with. Now, the next row I highlighted here was 2015. 2015 was a particularly unusual year for both strategies. If you notice on the left, if you had just bought and held, in 2015, you would have had P&L of about 17.2% for that year. If you look over in the middle section, in the primary strategy, we lost 10% that year. We had an account value of $23,000, lost 10%. We had a drawdown of almost 30%, and we had about 8 round trip trades. On the far right, we had a horrible year. We lost 36% of our account value. We ended the year down to about 12,500, and we had a drawdown of about 41%. So you see the difference between, if you had just bought and held, you would have made 17.5% in profit. Either one of these strategies would have had a really rough year in 2015. The other year I wanted to highlight is 2018. And there's a reason for these highlights, which I'll come to in a minute. If you, I don't know if you remember 2018, in October, the Fed was talking about raising rates. The market started collapsing. If you had bought and held, you would have lost 20% in your account value. Versus in Floyd's strategy, you would end up with a 7% P&L. And with the alternate Rick strategy, you would have made about 14% that year. If you notice something though, if you look at the account value in all 3 sections, the buy and hold has an account value of almost $86,000 on the left. In the middle, Floyd's strategy has an account value of about $45,000. On the far right, Rick's strategy has an account value of about $30,000. If you think about it, the buy and hold is pretty much kicking butt. None of the strategies are working out as well as buy and hold. But let's see what happens. And now come to 2022. This is very recent for everybody. If you had bought and held, you would have lost almost 80% of your account value that year. Your total account value from 2013 to 2022 would have ended up down to $161,000. If you had followed the primary weekly strategy, you would have had a loss of about 20%, but you would have had about $366,000. And if you had followed the alt strategy, you would have only lost about 4%, and you would have had $232,000. I want you to think about this because it's really interesting. 2022 was a horrible year for LETFs, especially for TQQQ. And yet, the alt strategy only lost 4% of its account value. That's pretty incredible in terms of losing money. This section summarizes everything together. We see that both strategies endured drawdowns of close to 50%. In terms of the round trip trades, the Floyd strategy only had 56 round trip trades in the whole 11 years, whereas 130 strategies for Rigs. Both were about 50%. If you look at the section that says percent profitable, you have 53.7% versus 48.46%. So close to 50% of trades were profitable. About half your trades were profitable. But the win percentage was much higher. So in the case of Floyd strategy, you had average win was a 27% profit. Your average loss was about 8.8%. Whereas for the Rick strategy, the average win was about 12.7% versus an average loss of about 5.2%. Even though both strategies had a 50% batting average, because the average wins were so much higher than the losses, you still get to grow your account. And just so you understand, the RT trades for Rick strategy is 130 trades round trip, which comes out to about 2 trades per month. That's all it comes out to in the whole 11-year period. If with 2 trades a month, this is the results you will get at the end of that period. This slide is important so you can understand. I'm assuming you know what CAGR is. Compounded annual growth rate. Basically, it's the rate of return required for investment to grow from beginning to end, assuming all profits are reinvested. We average this out across multiple years because it allows us to compare different investments and it smooths out volatility. So I broke all of these up into 4 different time periods, from 2013 to 2017, 2013 to 2019, 2013 to 2023, and 2017 to 2023. The reason I did that is because you'll notice how different the performance is for all the strategies across those periods. If you look at just 13 to 17, the buy and hold is at 71%. If you follow that across Boy strategy, it's only 33%. And over across the Rege alt strategy, it's only 21% or 28%. What's interesting is, if you look at what happens from 2013 to 2023, the buy and hold has a compounded annual growth rate over 11 years, 42%, compared to the primary Floyd strategy of 46% and Rick's strategy, 40%. To give you an idea of what these numbers mean, in that 11-year period, if you had just bought and held Apple, the compounded annual growth rate would be about 25% versus the 46% you're getting here. For Meta, it would have been about 26%. For Netflix, it would have been about 38%. So even any of those Mag 7 stocks, Amazon, Google, Apple, Meta, or Netflix, none of them performed as well over that entire period as these 2 strategies. Does anybody have any questions at this point? Feel free to unmute your mic and ask, or raise the little hand at the bottom. No? If I'm talking too fast, please let me know. I'll be happy to slow down. Any questions so far? So far, what we've done is we've completed. Hi, George. Go ahead.
Do you have the CAGR since its inception for TQQ till today?
I have that, but not in this slideshow. The inception was sometime in March 09 or April 09, but I can find that out and send that to you, Floyd, later. I have no problem putting that together for you guys.
Thank you.
Anybody have any other questions? So far, what we've done to summarize is we've taken a look at 2 weekly strategies side by side and a buy and hold strategy. We've done a year-over-year deep dive across all the strategies for over an 11-year period. We've covered the performance during downtrends, which is 2018 and 2022, and the choppy year, which is 2025. We have got an understanding of drawdowns and total number of trades. We look at the performance summary across the entire 11-year period, and we compared the CAGR over that time. So we have learned so far that, as Yoda says, you must invest, and money you will make. Do not be afraid. We're all here to help each other out, and we will get through it and be successful. This is an important section because it is something that affects all of us, no matter what stock we invest in or leverage ETF. Can we set a fixed profit target to improve results? Can it lower drawdowns? Will it cause us to miss out on larger gains? Will it significantly increase the total number of trades? These are all questions we have when we say, what if I set the profit target? What if it doesn't work? How do I know? So what we did is, in this case, we took a look at the alternative weekly inputs from Rick, which was the weekly 533, a daily stop of 5.8, a trailing stop for 18.8, overbought at 45, oversold at 10. I set a profit target of 23%. So every time we buy, once the ticker hits 23% above our buy price, we automatically sell. And I'll explain to you why did I select 22%? Why not 5%, 14%, 30%? So this involves a lot of back testing. And what I did is I tested different profit targets from 2013 to 2023 across the 11 years to see which performed the best. I tested it across multiple time frames, upholding everything else constant. I started with a 3-year time frame between 2013 and 2023. So like 2013 to 2015, 14 to 16, so on. when I did a 5-year time frame and a 7-year time frame. I consistently saw the 23% perform better. We're not just testing for higher returns, we're testing for worse drawdowns too. The next slide, I'm going to show you an example of what my own Excel sheet when I was testing a 3-year time frame. This is the example of my spreadsheet to find an ideal profit target. I use a trading script and enter various profit targets. We start with 0%, meaning no profit target. In this slide, you'll see we start at 23, 25, 30, but in reality, I had a lot more in there. But for the sake of this presentation, just to make it easier for viewing, I narrowed it down to these. You'll notice I start on the top left from January 11th to December 13th. Test them all. Then I go down to January 12th to 2014 and 2013 to 2015 and so on, all the way down to the year where we end up in 2023. And if you notice on the bottom of the slide, you'll see there's a 3-year, separate Excel sheet for 5-year and 7-year, which I am not showing over here. But what I realized on this top right section with the red box is if you look at it, I said, if I have no profit target versus all these different profit targets, which one wins out the most and loses the least? In this case, the 23% won out the most. Meaning of these 9 periods that I tested, a profit target of 23% won 9 out of 11 times. And this was the case for the 5-year and the 7-year as well. Now we'll get to see what the results look like. For those of you who want to use a trading view script, this is how it works. On the left, we have the same inputs, but a 0% profit target. On the right, same inputs, but a 23% profit target. So when we go to an 11-year test, what do we get? This is what it looks like. What we're comparing here is 2 sections. On the left, we have the weekly strategy with no profit target versus a weekly strategy with a 23% profit target. And we go through these year by year. I'm going to go through those in a little bit of detail here for you. You can see what the differences are. If we look at 2015, which was a rough year with no profit target, we lost 36%. We realized that setting a profit target didn't perform much better that year. It actually was about the same, a 37% loss, and we're not doing that much better in terms of our performance. By December 2015, both of these are almost identical, and they're both not doing very well. Now let's skip ahead to the other bad year, which is 2022. We remember that buy and hold lost 79%, a 0% profit target, only lost 4% that year. By setting a 22% profit target in 2022, we actually ended the year positive. I want you to look at the end of year value accounts. By the end of 2022, the account with no profit targets has 233 grand, whereas the one by setting profit targets with the same other inputs has almost double the amount of money. Okay. Oh, sorry. Okay. These are the 2 years I want to highlight because this is where we start seeing a difference in performance. By 2019, remember, you started with $10,000 in January 2013. By the end of 2019, the weekly alternative input strategy with no profit targets is at $68,000 versus setting a profit target is at $81,000. By the end of the 11 years, setting no profit target has given us an account value of $406,000 versus $675,000. The difference between these 2 accounts is about 66%. By setting a fixed profit target, making sure you have backtested the profit target, you can significantly improve your returns. That is the point of this thing. And if you take a look at the summary portion here, setting a profit target versus not setting one, a similar drawdown, we lost almost 50% in drawdowns. We only have 26 more trades over that whole 11-year period. This averages out to 2 extra trades per year. 2 extra trades per year to end up with a 66% higher account value at the end of that period. In terms of actual percentage,
Hey, this is your a great job. I know how much manual work goes into all of this because I do some of this as well. Something I noticed is why did you pick Rick's alternate model versus Floyd's model? Because when you were showing earlier the comparison, Floyd's model did better. Why start Rick versus Floyd? And the second question I have is, since these are all leverage funds, wherever you have made significant benefits in terms of dollar value, those are the years where we just came out of a bear market. For 2019, we had a bear market towards the end of 2018, which was very bad. So it makes the case that any uprising from there was really strong in the beginning. And that's why the leverage was better. Same thing happened in 2020. We had a very bad crash and then everything went up. So of course, leverage was better. And same thing happened in 2023. Again, the same situation. 2022 was a bear market and we had a nice run. That kind of explains, but if you look at the other years, not a major difference, a little bit here and there, but not a major.
Okay, let's go back. So the first question was, why did I do this on the alternate strategy? Why didn't I do it on Floyd's? I backtested various profit targets for Floyd's, just across 3, 5, and 7-year period and the 11-year period. I could not find a definitive profit target for those inputs that produce consistently good results. So that is why sometimes you will test profit targets in your strategies that may not give you consistent good results, and you might choose not to apply them because they don't make sense. In this specific case, the differences were so significant, I wanted to present that to you guys so that you can see that in some cases it does work. You just have to do some more digging to find that out. So that's the answer to question number 1. And answer to question number 2 is, let's take a look at this one right here. This is comparing both side by side. So you can see profit target versus no profit target. What I want you to look at is the account, because you were mentioning that 2019 or 2023 were bear market years and therefore significant drivers and so on. If you look at every year side by side, you will find that in every single case, the dollar value of the profit target versus no profit target is higher by setting a profit target. It's not a lot higher, maybe only 10%, maybe in some cases 15%. And the real difference doesn't start showing up till 2018, 2019 and onward. But the differences do start to stack up. And in this case, they were higher in every single period. A 23% profit target actually does work better. If you decide to put profit targets in, it might not work. It might cost the same results, worse results, might have bigger drawdowns. You have to see what works for you in all of those cases. 2022 was interesting because, as you said, it's a bear market and buy and hold lost 80% of its value in TQQQ. But if you look at the profit target columns, the account value and the P&L, even though it's only 1.7% of P&L, it's actually pretty phenomenal. The fact that we didn't lose any money in a year when TQQQ lost 80%. Consistently, year after year, mapping it out, deciding what to apply, whether or not to apply it. For me, if I was using this specific strategy, I would look at incorporating a profit target like this into my actual trading. But again, that's because I've done a lot of back testing and I feel confident enough to do that. Does that answer your question?
Yes, thank you. Appreciate it.
No problem. If I have not answered your questions, it's okay. Ask me again, I don't mind. On this slide, I was showing you the summary of comparing no profit target versus a profit target. What we see here is, if you look at the line saying percent profitable, meaning percent of winning trades, they're both about the same. With no profit target, you're at 48%. And with this one, you're at 47.4%. Your average win and average loss are about the same too. It's because a lot of times when something like this jumps out, it also makes it more emotionally simpler for an investor to get out. When you see results like this and you feel confident that this will work most of the time, it's something that takes the emotional stress out of getting out of a trade. Yes, you might lose some. Maybe if the thing goes up another 20% or another 5%, you can kick yourself. But the thing is, just because you take 22% profit does not mean you don't get back in the next day. According to the rules of the trading strategies, if your entry signals are there, you jump right back in again. So you're not actually losing out on future profits just because you take some profit, but you definitely nail down some profit. And this next slide is comparing the CAGRs for both strategies. They're exactly the same, except one has 0% profit, meaning no profit target. The other one takes a 22% profit target. If you look at it over every time frame, the CAGR on the right is higher than the one on the left. The cumulative gain after 11 years On the left, we have cumulative gain of 3,969%, and versus an 11-year gain of 66.55%. So you're getting a much higher cumulative gain for this profit target strategy over this 11-year period. Does anybody have any questions? I see two hands. Frank, go ahead, please.
I came in late and you may have covered this already, but when you come to the profit target and go back to reinvest, you reinvest everything?
Yes. If the entry signals are there and the entry indicators tell you to go in, then yes, you reinvest all your profits back in. In every single one of these years in this table, all profits have been reinvested if the indicators indicate that. Any other questions, Frank?
Yeah, I have reviewed all the earlier stuff. I just didn't know if you had different guidelines in this particular case.
No, the guidelines are identical to the other guidelines as per the Anchorage IBDs with Floyd and Rick's entry rules, exit rules. Adding a profit target is no different. If your profit target hits and you collect your profit, then you go back in according to the rules.
Floyd here, if I might add. If I add something there, Reggie.
Oh yeah, sure, no problem. George, I see your hand. Let me finish with Floyd and I'll get to you.
So Frank, that was an excellent question, Floyd. For back testing purposes, we reinvest everything so that we can manage apples to apples comparison between TQQ and different strategies or SOXL. In reality, if you have $300,000 and you get a sell signal and you sell all of it and you go to cash, you may not necessarily want to put $300,000 in the very next day. That's a personal decision that you have to make. And you may want to leg in on 2 or 3 strategies, but for back testing purposes, we reinvest everything simply so that we're comparing apples to apples. How you do that yourself could be different there, Frank.
George, please go ahead. George? So George is not asking any questions. His hand was up. I'll skip ahead to the next slide.
I was trying to unmute. Have you tried on SOXL, which I feel is even slightly better than TQQQ?
I'm sorry, I didn't hear the question. You can apply this strategy to any leverage ETF or any stock as long as you do the back tests, comparisons over multiple time frames, and you feel confident that you're seeing.
Okay, and my second question is did you compare going all in one buy versus pyramiding in?
No, I did not compare. I did not do any pyramiding. Every single thing was all in on one buy. And those are the results that we're showing you here.
Gotcha. Thank you.
Anybody else have any? Oh, showing Gary. Go ahead, Gary.
What is the best month to go back and watch to learn the rules, the basic rules?
Floyd, did you want to answer that?
Yeah, the best month is the September 2023 meetup. There's been some subsequent presentations, but to learn the fundamental strategy, September 23, if you send me an email at tqqinvestor@gmail.com, I will send you a link to that monthly presentation and be happy to do that.
Does anybody have any questions?
We've done lots of back testing with SOXL. In the March or April presentation, we gave summaries. In the early years, I think TQQ was doing better. More recently, SOXL is performing better primarily because of AI, NVIDIA, and other stocks taking off like a rocket. This year, for example, SOXL has performed about twice as good as TQQ, but that's not true in every year.
Floyd, do you think that going forward, SOXL will outperform TQQQ just because of what you said, that AI is still in its infancy?
Nobody knows what's going to be the best way to go forward. If we look at recent history, if recent history continues at least another year or two, SOXL and FNGU probably will perform better.
We have a couple of questions. Mr. Umpati Loganathan, did you want to go ahead and unmute and ask? The Loganathan? Are you there? We also have Gary Povich. Gary, if you want to unmute and ask your question.
Yeah. Is the TradingView script available for anyone to play around with?
If you want to get your hands on the TradingView script, you have to email Gary Taylor. If you don't have his email, posting the Anchorage IB Meetup chat, we're more than happy to share Gary's email with you. You can reach out to him, and Gary will be able to give you whatever information or access that you need.
We can share the links to those messages. The question was asked, what happens if you hit a sell signal before you hit your profit target? Well, obviously you sell. You always, when you get a sell signal, no matter what, you sell.
Correct. Okay. Did you want to go ahead and unmute and ask a question? I have Robin and Sir Olapathy Olganathan. Oh, Robin.
This is Robin.
Hey, Robin.
That we're reinvesting dividends.
That's a big question.
In the back testing, we're not throwing dividends in. You can set up an account with your broker and you can tell your broker you want dividends reinvested or you want dividends in the form of cash. But for leverage ETFs, the dividends are relatively small, so it's not a big deal. It's up to you and your broker on what you want to do with any dividends.
All right. Thanks, Floyd.
Are you buying back the same time for comparison? I don't know. My question was answered. I will lower that. Somebody asked.
Yes, we always use the same time frame.
Are there any other questions so far? I'm just going to go through a summary, but if you have more questions, please feel free to ask them. I'll do my best to answer them. If I can't, Floyd will have you answer them too. At any point, feel free to raise your hands and we'll get your question out to the group. So far, the TV script allows investors to backtest several different profit targets. We must analyze each profit target across multiple time frames for consistency. We must check if the profit target affects drawdowns. And we have to take into account other factors like total number of trades, percentage of winning trades. We need to do all this to verify whether increased returns from profit targets actually justify the risk of increased drawdowns, increased trading, and so on. So it's all about what your strategy is. If there is one that works across all the different time frames, it requires a lot of manual backtesting work, but it can pay off quite well in a lot of cases. And if you can't find one, that's fine, because then you feel confident that there isn't one that works and you're still on the right track. All right. Next slide. So daily stochastics. So far, we've looked at various weekly stochastic strategies. In March of 2023, Gary's TradingView started offering an option to switch to daily stochastics. And daily stochastics offer an investor a chance to capture changes much faster. And adding a profit target may improve the results too. I have not back tested for ideal targets. What I'm going to show you guys here is a set of inputs that Gary presented in the May 2024 webinar. Gary's inputs were a daily market smith stochastic of 2015-5, stop 6%, a trailing stop of 11%, a profit target of 16%, going long, shorts, and exit line of 37. We're going to test the same time period between January 2013, December 2023. This is exactly how the inputs go into TradingView for a daily time frame. We pick D for daily, mixed stochastics, a trailing stop of 11.1, a daily stop of 6, profit target of 16, the exit line of 37, the long and the short, and the actual daily stochastics of 2015-5. And these are the results. On the far right section, those 4 columns there, those are the results of the daily stochastics. There's a lot of data here. We're comparing buy and hold to the primary stochastics from Floyd, to the weekly stochastics from Rick with the 23% profit target, because that's performed better to the daily ones. So let's look at this in sections again. So we look at again the year 2015, which was a choppy year for TQQQ, even though it finished up 17%. As you all remember, Floyd's strategy only lost about 10%. Rick's strategy, even with the profit target, lost about 37%. Now, our daily stochastic strategy was down almost 40%. The account value for the daily is at 10,986. We have been trading for 3 whole years. We started with 10 grand, and at the end of the 3 years, we're at barely $11,000. So it's not going well so far, but let's keep on going. Now we're at 2018. Now, in 2018, the buy and hold strategy that year lost about 20%. Floyd's strategy made about 7%. Rick's strategy with the profit target made about 20.95%. And the daily strategy for that year alone made about 26%. But if you look across the account values, the daily is still struggling really bad. It's the lowest of all the three. Okay. Now we go back into 2019. 2019 was a bumper year. If you had just bought and held, we would have made 133%. Through Floyd's strategy, we are at 92% that year. Rick's strategy with the profit target hit 142%. And the daily is now at 174% for that year. The three strategies are quite similar in value, 86,000, 81,000, and 80,000. It was a big jump for the daily strategy because it was trailing so far behind. All three strategies, the two weekly and the daily, are still trailing very poorly behind a buy and hold. If you were somebody who's doing any of these strategies, you would have looked at the buy and hold and we'd look at your account. I should have just bought and held. But let's see what happens a couple of years later. Now we're at 2022, which is the terrible year, where a buy and hold lost 80%. Lloyd's strategy was down 20% that year. Rick's strategy with a profit target gave us a positive 1.7%, and the daily strategy ended up with 37.5% that year. Think about that. You had a year in which TQQQ buy and hold and the entire market, with buy and hold lost almost 80% of the account value, and trading this same daily strategy ended up 37%. Look at the total account values across the board. At the end of 2022, the strategy on the far right is at $600,000 already. Look at what happens in 2023. In 2023, as we know, TQQQ bounced back, or it's almost up 200%. Floyd's strategy got us up 82%. Rick's strategy, even with a profit target, was up 53%. And look at the daily strategy, it was up 130% on. And look at the account value on that. Now, realistically, I want you to think, could an investor have stayed this long with this strategy, knowing it was trailing for so many years, only to end up with almost $1.4 million in your account? These numbers are 2015-5, where he puts that Gary had recommended from one of his back tests that worked really well. I wanted to break it down year over year so we could get a full picture of what happened. So when we look at a summary page here, we look at three strategies: the Floyd, Rick strategy on the far right. We have the daily strategy. We notice the daily strategy had a max style of almost 60%. Okay? We had 219 trades versus 156. We also had, on average, lower percentage of winning trades. The daily was about 45 versus 47 for Rick and 53 for Floyd. And we still had a decent average win versus average loss on this page. We have four different strategies here. We had the buy and hold on the left, Floyd's, then Rick's, and on the far right, we have the daily. If you look at the daily, from 2013 to 2017, it was trailing all the other strategies. It only had a CAGR of 18.2%. By 2019, it was 34%. And if you look at the entire time frame, the 11-year period, it beat everybody hands down. And what's most interesting is, if you test it from 2017 to 2023, it had a compounded annual growth rate of 97%. So this is a strategy that from 2013 to 2017 was lagging everybody. But from 17 to 23, it was incredible. The point I'm trying to make is that if you are testing any strategy, stock or leverage ETF, and you don't go back far enough, you might be fooling yourself into thinking you have found a fantastic strategy. If I had only tested this strategy from 2017 to 2023 and seen this result of 97%, I would have been elated. But I would be fooling myself because I didn't go farther back and do all of these tests. And that's why it's important, because we don't know what's going to happen next year. We don't know, our next 5 years is going to be a repeat of these. So we have to be ready for a not so great case scenario. Does anybody have questions about any of this? Yes, George, go ahead.
What would you say is a primary reason that the daily caught up so quickly and then blew past all the other strategies? Would you say it had something to do with the stock market crash in 2020 and the bad 2022?
For this specific strategy, if you notice something across all the strategies on this page, if you look at the CAGR for all three strategies from 2017 to 2023, you'll notice that all of them are performing better than the years before. 2017, we had the Trump tax cuts where corporate taxes were dropped and stock market went crazy. All right. 2018, we only had about the last 2 months when the Fed was threatening to raise rates and the markets took a dump, but then the Fed backed off and the market shot up again. And then 2020 and 2021, all that enormous QE came in from the Fed, plus all the money that the federal government sent out to everybody. We had an enormous amount of liquidity pumped in. The only real bear market we had was 2022. And 2022 was the year that this strategy performed really well. The daily strategy ended up with 37.5%. I don't know why it performed so much better in 2022, but all the other years, it was simply a beneficiary of a lot of tax cuts and liquidity pumped into the market. Not losing money in 2022 really helped propel it forward. So that's just my take on it. Other people might have other thoughts, and you're welcome to share those if you want. Now, if you guys have any other thoughts or ideas of why you think it did better, please jump in.
Thank you.
Does anybody else have any questions or comments at this point? Keep in mind, the importance of this is to show the reason to go back farther in time if you can. I mean, I know ETFs are only born in 2009. TQQQ SLX came alive in mid-2009, but it's good to get a decent amount of time under testing so you feel confident in moving ahead with the strategy. All right, so a summary of this. Backtesting longer timeframes is absolutely necessary.
Hey, this is Yogi.
Go ahead, sir.
A quick question. Is there a way in TradingView where we can start every year with 10,000, have a cumulative total of whatever is there in the bucket?
If you're using this trading script, the only way it'll give you the account value for the period you choose to test for. If you test from January 2013 to December 2013, it'll give you all the results for that year. If you break it up from say 2013 to 2015, it will only give you a cumulative amount. For those of you who are paid TradingView members, you can do what I had to do was I had to export the list of trades. For example, from 2013 January to December 2023, if there were 300 trades or 500 trades, I had to export the entire list of trades and I had to manipulate them manually to get the results I wanted. Does that sort of answer your question, sir?
To some extent, but thank you. If you start with 10,000 every year, and at the end of that year, you see what was the drawdown on the account and how much PNL happened, it gives a much better picture. As you showed in the first 3 years, on the third year, we pretty much lost everything and went back to 11,000, which is kind of peanuts. Let's say I was the trader who only started that year, pretty much my account is wiped out. I mean,
yes, you are absolutely correct. To answer that question in this trading script, you can start any year you want. You can test just for that year. It'll show you results for that year. If you tested that way, you started trading in January of 2015 using the far right one with the daily script, you would be down 40%. Be devastated. I don't know what you'd be doing, but yes, you're right. You would be in a world of hurt, financial hurt. And if you had started, you would have to dig yourself out of a hole. So the year you start matters a big deal. And to answer your question, yes, in trading, you can do that. You can actually go in and start any year you want for that specific year. You can see what the P&L was, what their total number of trades was, and the yearly drawdown was, and so on. The account value may not match mine exactly because, as I said before, if there's an open trade that was placed on December 15th, but doesn't close till January 23rd, I don't calculate the amount of January 23rd. I look at the account value on December 31st and I put that in this table. But for any of you who wanted to use TradingView, who wanted to check it on a year-over-year basis, you can actually go into that year and see if you started that year, what would have happened to you. And in this case, you would have been down 40%, which would have been a horrible year. Does that answer your question a little better?
Yes, absolutely. Thank you. And the second one I had was, since these are leveraged ETFs, and especially when the market goes down, usually we will see reverse splits on this. This is a common practice for leveraged ETFs to keep them listed on the exchanges. Do you think that would have any effect? Because splits for stocks is very different versus splits on leveraged.
Actually, you use the word reverse split, which is actually the opposite of what's happening for TQQQ. If you use SQQQ, you would see a reverse split. A reverse split is the stock value is down so low that they have to vacuum up shares to make them into a big group so that the share value comes back to a normal number. For TQQQ, it has never gone through a reverse split. It has only gone through splits the way NVIDIA did recently, or Apple has, or Google has, and so on. Because the value of TQQQ usually has not gotten so low that it has required a reverse split. If in fact TQQQ has, on average, increased consistently so much that they have had to keep forward splitting it the way NVIDIA recently did.
Do you think that would affect the returns?
I don't see in this 11-year period, for example, a lot of that, there have been many splits, many splits that happened in this 11-year period. For example, if you went back into whatever, say, NASDAQ or Yahoo Finance or anywhere else where they have the old share value, and go back to January 2013, the share value you will see is something like 21 cents or 4 cents. TQQ was never 4 cents. All of these numbers include the effects of splits already. It adjusts itself by price. And if you already own the shares, it just happens internally anyway. So that has not had an impact. And that's already included in these tables that I put together.
Okay, thank you.
No problem. Does anybody else have any questions? Ford, go ahead, sir.
I'd like to ask about your calibration settings for the stochastics.
Are you talking about the weekly or the daily, or does it matter?
It doesn't really matter, but when it comes to your calibration settings, so these are for TradingView and for MarketSmith, but would these same calibrations hold if one was to use another platform, like say stock charts?
I'm not familiar with stock charts, but I know that the MarketSmith stochastics formula, rather the code, Floyd has shared that, and many people in this group have shared that for Thinkorswim. So I know that many people have inputted them into Thinkorswim and used them as indicators for the market stochastics. In terms of additional platforms like stock charts, the code is available in a script format. How you would encode that into a specific platform would depend on the actual coding for that platform. But the logic and the algorithm is there. That's available to anybody who wants to use it. If you hire a programmer or you do it yourself, you should be able to do it in that platform.
Floyd here, I'll just add a comment. Back when it was called MarketSmith, now Market Surge, 20 or 30 years ago, they decided to use closing prices only for the high price, the low price, the closing price. And we have no idea why they decided to round down or truncate all numbers, meaning that if the fast line was calculated at 39.9, it is reported as 39. If it's calculated as 19.9, it's recorded as 19. The reason there's differences in normal stochastics and market style stochastics are primarily those two reasons, using the closing prices only, whereas normal stochastics use the intraday high and etc. And the normal stochastics don't truncate or round down. As all of us that have been working on this for a long time, is that if you try to optimize TQQ using normal stochastics, we don't get as good a performance. For SOXL, we use normal stochastics, but for TQQ, for whatever reason, when we do the back testing, TQQ's performance is enhanced dramatically. And so we don't necessarily have a good reason, but the math tells us that for TQQ, you use market style stochastics. And if it's weekly, the period is 533. If you're using SOXL, you use normal full stochastics with the period of 533 if it's our weekly strategies. I hope that answers the question. I think it's in the September 23 presentation. We explain how MarketSmith calculates their stochastics. If you email me, this is Floyd at tqqinvestor@gmail.com, I will send you a link to the Thinkorswim screen that automatically puts in the market style stochastics for TQQQ and the full stochastics for SOXL.
Quick comment to add to that. If you look at the chat that is going on right now, somebody has posted a link the same one that Floyd would have sent out to you. If you access the chat, you can take that link and put it into Thinkorswim. If you use it, it will give you access to the actual script code, which you can put into any platform.
Fantastic. Thank you for posting that. Sometimes you have to wait 24 hours before the link works, and I don't know why Thinkorswim does it that way. If that link is to the same screen that I've been using, you're going to see two sets of stochastics. Use the one marked Marcus Smith stochastics when you're using TQQQ, and the full stochastics when looking for your buy and sell signals for SOXL.
So just to clarify, that link is for TQQQ.
That link is for Marcus Smith stochastics.
Oh, that is for Marcus Smith only? Does that only include the Marcus Smith ones?
If you want to answer that. Oh, it's Marcus Smith only. Yes, it's Marcus Smith only.
Thinkorswim already has full stochastics, so they can add in themselves. This is just market stochastics because that is not in Thinkorswim platform itself. So we created this one and then
you can do full for SOXL. Use this one. The link here, Marcus Smith stochastics, if you're trading TQQQ. If there's any confusion or anyone wants to talk to me about it, just shoot me an email and I'll be happy to respond. If you want any guidance on TradingView, I'm not the TradingView expert. That's Gary Taylor. I'll find Gary's email and I'll post it on the chat here just in a little bit. And he's more than happy to answer. He's done 2 or 3 training sessions now, and Gary's mentoring about 20 or 30 traders. And we've challenged those traders to do massive back testing. And our challenge to them is find variables that work better than the ones we found. We're always wanting to do better. And if someone can find a better trailing stop or a better profit percent target, we promise them 100% credit for doing that.
There was a question in the chat. Any ideas which stochastic works better for LETF like FNU, UPRO, etc.?
Yes, FNGU, Marcus Smith stochastics works best for FNGU, and for SPYU or UPRO, Marcus Smith stochastics seem to work better. The only one that needs full stochastics from the testing I've done is SOXL. But please do your own back testing. Convince yourself, and maybe you'll come up with a better idea. My plea to you is don't blindly accept what Gary, Rick, and I have come up with, especially if you're using serious money. Do your own back testing and convince yourself that you understand when you should enter a position and when you should exit a position, if you should get out at a profit target or not. For example, with TradingView, it's very, very easy to do your own back testing and look at changing those variables. In 1 hour, I probably could do 100 back tests or maybe even more. And so I would encourage you to prove to yourself that the information Reggie's presenting tonight will work for you. We're shining a light on how to trade leveraged ETFs, and Reggie's just doing an excellent job of doing that tonight, isolated to TQQQ. And I think it will be a good starting point for you, but I challenge you to see if you can do better by doing back testing, or at a minimum, prove to yourself that what you thought was going to be better actually is not better. Because I've had several people suggest to me that maybe we should take profit sooner or take profit later. Well, back test it and prove to yourself through doing the actual back testing that what your gut is telling you better, 9 times out of 10 is not better. And so figure that out, please.
Patrick, to your question, which stochastics work better for ETFs like FNGU and UPRO? To my knowledge, FNGU is relatively new. We don't have enough history on that to actually say one way or the other. Secondly, to add to Floyd's comment, whether you're testing on TradingView or any other platform, one of the things people do is we tend to look at the whole 11-year period, in my case, let's say. You started January 2013 to December 2023, 11 years, and you punch in all these variables and you come up with a very exciting number. The reality is, if you want to feel confident in your decision, you have to do this kind of research for yourself that I'm showing you here. Because as you can see, when you have really bad years like this one, as Yogesh pointed out earlier, imagine this is your first year. You put in 10 grand at the beginning of 2015 and you lost 40% of your money. So be realistic in knowing what you can handle and whether or not you can sit through these kind of drawdowns. Because it's easy to look at the end of the whole 11-year period and look at, wow, 1.4 million. But guess what? What did that person have to go through to get there? Would you be able to do it? In order to do that, you have to go into more details. It takes time, a lot of manual work, but it'll give you the confidence or the deterrence whether or not you want to pursue that strategy or not. So I'm back to where we were. Like, anybody has any questions at this point, please go ahead and ask. I'll be happy to answer them. If not, I will proceed on to the next slides. As I explained to you on the far right, using the daily market Smith Stochastics for TQQQ of 2015-5. And remember, these numbers are, I picked these numbers because Gary had mentioned them in the May webinar. If you look into the chat, Gary's email is there. If you have any questions about TradingView, feel free to contact Gary. The reason I'm pointing this out is because in the May webinar, this daily stochastic value of 2015-5 with certain profit targets was touted as having this phenomenal return from 2017 to 2023, which it does. 97% category is fantastic. But you have to go farther back to see how you would survive. If you're looking out another 10 years, we don't know what's coming. As long as you have a strategy that you're confident in, that you can stick to and adjust when needed, you will feel more confident in your investing. I'm going to move on to the next slide. Daily stochastics, what we've gone through, summarize, is backtesting a longer time frame is a must. Whether you're doing it for an individual stock, whether you're doing it for an LETF, you have to test for as long as far back as you can. You notice how differently a daily strategy performed between 2013 to 17, or 17 to 23. And trading in daily stochastics involves more frequent trades and some more attention to your position. If some of you are like Floyd does not like trading very often. Maybe Floyd trades like once every 8 weeks, 6 weeks. If that's who you are, then you have to pick a strategy that caters to that. If you're the kind of person who likes to pay attention to it every day, not necessarily trade every day, but pay attention every day, and maybe you're okay with trading once or twice a week, then you might look at a different strategy. And across the 11-year period, we saw that the daily strategy had a much deeper drawdown than the weeklies, and the daily strategy had a lower win rate compared to the weekly. So even though it had an average win rate of 44% versus the other weekly ones with 46%, we still ended up with a higher amount at the end of the 11-year period. We encourage the investor to test multiple daily stochastic entries to find better performing results. Keep in mind, as Yogesh pointed out, you want to test them every year, not just the whole 10-year period or 7-year period. This is what we've learned so far in practice. We feel really smart and excited when we find a theory. We put it to work, it doesn't look so hot. So we're going to talk about drawdowns and losses because this is the main factor in any sort of investing or trading. Everybody likes making money and they get very excited when we're making money, but then there's these things called losses and drawdowns. From 2013 to 2023, in that 11-year period, the buy and hold strategy had drawdowns of over 25% in 2015, 16, 18, 2020, 2022, and 2023. And 3 of those losses were over 45%. 2018, 2020, and 2022. So buy and hold, if you had buy and held, do you have the stomach to watch your portfolio go down 45%? The primary strategy had drawdowns of greater than 25% in 2015, 18, 21, and 22. The alt strategy with no profit, so no profit target, had drawdowns in 2015, 22, and 23. And the daily strategy had drawdowns of over 25% in 2015, 18, 21, and 22. So none of the strategies, including the buy and hold, are immune to nasty drawdown. Here's something to look at last summer. From July 14th to October 30th, the TQQQ buy and hold dropped over 30%. How did our strategies perform? If you had done the primary strategy, You would have had 3 round trip trades, really 6 trades in total. You would have lost money on every trade, and your portfolio would be down 32%. For the alternate strategy, you would have had 5 round trip trades in total. You would have lost money on every trade, and your portfolio would have been down 34%. And if you were on a daily strategy, you would have had 4 round trip trades, which is 8 total trades. You would have lost money 3 out of 4 trades, and you would have been down about 15%. So the question is, can an investor stomach a series of losing trades? And Floyd talked about this in the May presentation. What happens to investor confidence when you see your portfolio drop that one? Trade after trade in night. What happened after October 2023? From October 2023 to March 2024, the primary strategy returned over 53%, and the alternate strategy for PQQ returned over 42%. So essentially from July 14, 2023 to March 15, 2024, both strategies barely broke even. So all the trades you were executing were just basically to get back. The question is, how can strategies be improved to reduce significant losses? Are there indicators, technical or other, that can help us reduce losses? And if we try to reduce losses, will we miss out on larger gains? I don't have any answers. These are just some things to think about. Some final thoughts for you all. The slides in this presentation focus on TQQ, but the strategies, processes, and analysis can be applied to any LETF or any equity. A strategy that applies to one stock or one LETF might be terrible for another. For example, as Floyd mentioned, market Smith stochastics seem to work better for TQQQ versus full stochastic work better for SOXL. The purpose of this whole presentation is to demonstrate to the investor how to conduct a deeper analysis of broad results and the realities of what to expect. As you can see, detailed backtesting requires time, analyzing positive and negative results based on all available data. You have to be aware of curve fitting. Curve fitting is where strategies are designed to show exceptional performance for a certain time period, but when you apply these strategies to other time frames, you hurt your portfolio. There's always somebody with a new strategy, or you might convince yourself that you have found a great strategy, but the reality is you have to really test it across different time frames. When we are awestruck by the final result of 10 years of any strategy, we need to remember what the reality required. Multiple losing trades, significant drawdowns, confidence killers. Could you have stuck with it? Every strategy needs to be adjusted to your level of risk, which is what Floyd talked about. And you got to know yourself really well. Emotionally, physically, mentally, you have to know what you can handle. Not just the dollar amount, but a series of continuing trades where you're losing money. You have to know how you can handle them psychologically. Lastly, some useful wisdom for everybody. There are no ideal solutions, only trade-offs. People often overestimate what they can do in 1 year and underestimate what they can do in 10 years. So your time frame is really important. The last one is from Mark Minervini. I don't know if you guys know Mark. He's an exceptional trader, runs his own program. He's been doing it for 40 plus years. He says, on every trade I make, I have a stop loss, a predetermined point at which I cut my loss and then reevaluate. I know this level even before I enter the trade, and not a single trade is made without it. I owe my entire success in the stock market almost exclusively to stop loss. And as you saw in all the strategies, both the weekly and the daily, stop losses are a part of that strategy. That way, when you go to sleep at night, if you have set everything up for the next day, you are not going to go to sleep wondering what's going to end. If your stop loss gets hit, you will get out and you know you're okay. All the slides presented here will be available for download in a few days. A video recording of this event will also be available to everyone. If you guys want to contact me, that is my email. I'm welcome to comments, suggestions, questions, feedback. There's specific topics that you want to see covered in more detail or new topics that you want to see covered. I'll be happy to try to get them to you in the next presentation. And hey, somebody raised their hand. I think it's Gary. Go ahead, Gary.
When you did your back testing, did you do that manually or did you go to this trading view program and plug things in?
All the tables that you saw with all the different columns, all of that was done manually. Trading view will give you a broad overview, but you have to export all the trades. You have to go through them, manipulate the data to get accurate results, and then plug them into that table. It's a manual process.
Thank you.
Okay. The next Anchorage summer session is on Thursday, July 11th at 8:30 p.m. Eastern. We will send out a link to everybody a couple of weeks before. I hope you guys have gotten some value out of this. It's my first presentation. I hope it wasn't too numerical or too detail oriented. I thought it would be useful to give you an idea of what I do before I decide to move ahead with a strategy. It's very tempting to jump in with both feet, but I've done that before and it's worked out for me, and other times it hasn't. So it just becomes random and there's no strategy then. George, go ahead.
Great job, and thanks for all your hard work.
Yeah, no problem. Like I said, guys, that email is available, omginvestors@gmail.com. If you have topics that you want to see, if you have other areas that we may cover, if I can cover them, I'll be happy to cover them. I'll send out an agenda in a couple of weeks. Floyd will get that out to you, everybody, to discuss the topics that are coming up that I'll be putting together for July. If you get back to me in the next few days with comments, suggestions, feedback, I can include that in the next presentation. I'll open the forum to anybody who has questions or comments.
Floyd, your absolutely excellent presentation, Rege. You're very thorough and you're good measured pace and et cetera. I'll let everyone know that using our strategy, Rick, Gary, and I have been trading along with several other people. We bought TQQ on November 1, which was a Wednesday, and our weekly strategy says you buy on a Friday. We bought 2 days early. And we only got a single, using the weekly strategy, we got a sell signal on March 15th.
Floyd, are you talking about your weekly strategy?
Yeah, my weekly strategy. We made 72% from November 1 to March 15, and then we jumped back in shortly thereafter. I don't have the percentage number in front of me, but we're up very substantially. Several of us are following our system right now. Several of us are 100% invested in TQQ, SOXL, and SPYU. And for some reason, they changed the symbol, but we're all in right now. We're very conscious that we're not going to be all in maybe next week or next month, that the market will change. The market will hand us a sell signal. And we have to be disciplined, and we have to sell when we get the sell signal and then wait for the buy signal. I wish everyone well. If you have questions, send Reggie an email. You can send me an email. The leverage ETFs are fairly exciting, but when the market turns, they go down very fast. You have to be careful and disciplined, have great sell rules that you actually follow, and have the courage to pull the button and go to cash. Sometimes the smartest position for you is to be in cash. That's all I'm going to say.
Thank you, Floyd. If anybody has any other questions at this point, please go ahead and ask. If there were any slides you want me to go back and cover again, I've set aside 2 full hours for this, so we have another 20 minutes. If anybody has any questions, I'm happy to go through any slides that were confusing, or if I talk too fast, or I did not cover them to your satisfaction. Anybody have? Yes, there will be a recording. It is being recorded, and the recording will be available in a few days. Anybody have any questions at this point? Comments? No? Okay. Looks like we're good. Floyd?
Thank you. Excellent job, buddy.
Thank you. All right, I'm going to close this up. I'm going to stop recording now. And everybody have a good evening, and we will be in touch with you all soon.